On Friday, January 30th, 2026, silver was trading near $115 an ounce in New York earlier in the week. 53, a one-day collapse of about 31%. In the middle of the panic, quotes showed silver down as much as 36% intraday before it found a bid. Gold did not escape. It dropped roughly 11% to about $42,145 per ounce at one point. And other precious metals were dragged into the same vortex. Not months, not weeks. In 48 hours, the trade that had looked unstoppable turned into forced liquidation. And what makes this move so uncomfortable is that it arrived right after people were told the opposite story. The dominant narrative going into the week was simple. Deficits, geopolitics, central bank buying, and a weak dollar were a one-way train for precious metals. Then one piece of information hit the tape, and the train reversed direction at full speed. Here's the line that kept repeating on trading desks. This could not happen without a crisis. Yet it did happen, and the crisis was not a bank failure, not a war headline, not a sudden default. It was a snapback in the dollar and the chain reaction that follows when the dollar stops falling and starts rising in a market built on leverage. Institutions already understand this mechanism because they've lived through it. They price it into risk models, margin models, and hedging programs. Most everyone else experiences it as a surprise. And the surprise is the point. When a crowded position meets a policy shock and a margin shock, the why doesn't matter for the first move. The plumbing matters. What I'm about to lay out is not opinion. It's the sequence. It's the way a dollar move becomes a metals move, then becomes a collateral move, then becomes a volatility move, and finally becomes a sentiment move that spills into everything from equities to credit. Welcome to Macro Signal, where we decode what matters before it becomes a headline. And we do it by following the data, not the noise. If you like the feeling of having the map while others are still arguing about the weather, consider subscribing and drop a quick comment with where you're watching from. I read them and it helps keep the conversation grounded. Now, let's reconstruct the event the way the market actually experienced it. The spark was not a rumor about mines or a refinery shutdown or a sudden change in jewelry demand. The spark was monetary policy expectations, rewritten in real time. On January 30th, headlines around President Donald Trump's intention to nominate Kevin Warsh to lead the Federal Reserve rewired the market's baseline assumption about the path of rates, the size of the Fed's balance sheet, and the political tolerance for inflation. Whether you agree with that interpretation is irrelevant. The market traded the interpretation, and it traded it immediately. That is why the sell-off did not stay contained to metals. Equity futures softened, with major indexes off around 1% in the immediate aftermath, and risk-sensitive markets around the world wobbled. 6% in one session, which is not what a calm, orderly market looks like. When macro pricing shifts, it tends to show up everywhere at once. In the hours around that shift, the US dollar stopped acting like a punching bag and started acting like a magnet. 8% on the day during the worst of the metal slide. At the same time, Treasury yields became the second screen everyone watched. 2% on the 10-year were back in focus, and the curve sent mixed signals as traders tried to guess what a new chair could mean for growth, inflation, and the speed of policy normalization. And then the most important thing happened. The dollar move spilled into the commodity currency complex. When the greenback strengthens quickly, it is rarely isolated. Traders sell the currencies that tend to be long commodities and global growth because those baskets are built the same way risk is built. That spillover matters because it tightens the feedback loop. A stronger dollar pressures commodities, weaker commodity currencies reinforce the dollar, and the loop accelerates. If you want to understand why gold and silver can look invincible on Monday and fragile on Friday, you have to understand that they are not only commodities, they are also macro instruments. They are the inverse of confidence in paper, and paper is priced in dollars. So when the dollar snaps back, the first thing it hits is the most leveraged expression of the debasement trade. That's futures and options, not jewelry. That's paper positions that can be closed with a click, and that must be supported with collateral every single day. The initial downdraft was violent because positioning was extreme. Silver had surged more than 250% over the prior year, and in the same week, it had printed above $114 in New York. Reporting also described China paying far higher prices at the peak, with quotes above $140 an ounce in some venues. Those numbers matter, because they tell you the market was already stretched, and stretched markets do not need a big shove to fall. They need a small shove at the wrong angle. Then came the second shove, and this is the part many people miss: margins. After the historic plunge, CME Group raised margin requirements on COMEX gold and silver futures, 6%, 1%. The change was slated to take effect from Monday's close, which sounds procedural until you remember what margins do in a leveraged market. To translate those percentages into pressure, think in contract terms. A standard COMEX silver futures contract controls 5,000 ounces. At $100 silver, that's $500,000 of notional exposure. An 11% margin requirement is about $55,000 of collateral, and 15% margin requirement is about $75,000. That is a $20,000 cash demand per contract, arriving right after prices just collapsed. A standard COMEX gold contract controls 100 ounces. At $5,000 gold, that's also $500,000 notional. A 6% margin is about $30,000. An 8% margin is about $40,000. That's another $10,000 per contract. Multiply that across portfolios that hold dozens, hundreds, or thousands of contracts, and you see the problem. Margins are the gatekeepers of participation. When the exchange raises them, it is demanding more cash collateral from anyone who wants to keep a position open. If you're fully funded and lightly leveraged, it is an inconvenience. If you're running hot with leverage, and parabolic markets encourage exactly that, it is a forced decision. Bring more cash, cut the position, or get cut by someone else. That is how a price move becomes a cascade. As silver fell, margin requirements rose, and as margin requirements rose, the selling pressure intensified, because the fastest way to meet a margin call is to sell the position that caused the call. The result looked like chaos, but it was actually mechanics. Silver plunged in an intraday air pocket, and gold broke through levels that had looked unbreakable days earlier. Even after the Friday shock, the selling didn't simply vanish with the closing bell. On the next trading day, spot gold was still quoted around $4,608 per ounce at one point, down another several percent, while spot silver hovered near $78, down again on the day. That matters because it shows a second wave, the weekend risk reset, where funds, dealers, and hedgers reassess exposure with new margin tables and new volatility assumptions. This is also where the contradiction enters, because while paper was being dumped, the real economy was still screaming for metal. The Wall Street Journal described supply chain strain in silver, shipment backlogs, even a shift from ship to air freight, because the metal is not just a store of value, it's an ingredient. Solar manufacturing alone was described as about 17% of global silver use. When silver surges, it is not just a headline for investors, it's a cost shock for industrial buyers. And in that same reporting, a smuggling incident involving about 500 pounds of silver at the Hong Kong-Shenzhen border was held up as a symbol of how intense demand and arbitrage pressures can become. 500 pounds is roughly 7,100 troy ounces. Not a world-changing amount, but as a headline. It tells you something about incentives. Think about the psychology there. If industrial demand is real, if logistics are strained, if physical urgency is elevated in parts of Asia, why would the price collapse? Because the futures price is the marginal price. And the marginal price in a leveraged market is set by the most stressed seller, not the most patient buyer. That's the dislocation. Paper price can fall even as physical urgency rises. And that dislocation cannot last forever. It resolves one of two ways. Either physical demand cools as prices fall and substitution kicks in, or paper selling exhausts itself and the price snaps back once the forced sellers are gone. To see why this pattern keeps repeating, we have to go backward. In 1980, silver went through a legendary boom and bust. The details differ, but the mechanism rhymes. A parabolic run, a crowded trade, and then margin changes that broke the back of leverage. When the rules of collateral tightened, the market did not decline politely. It dropped in steps because each step triggered another round of forced selling. In 2008, the dollar surged during a global scramble for liquidity. In that moment, everything that could be sold was sold, including gold. Metals did not fall because the long-term story vanished. They fell because the immediate story was cash, and the dollar is cash to the world. Then, when policy responded, the next phase arrived, and metals eventually recovered. Not because magic happened, but because the policy mix shifted again. In 2011, silver again taught the same lesson. After a breathtaking run, a series of margin hikes and volatility shocks turned what looked like a durable trend into a trapdoor. People remember the headline, "Silver crashed." But the important detail is how the crash propagated. It propagated through the leverage infrastructure. And in 2013, gold experienced a modern version of the same phenomenon. A sharp break, a loss of confidence in the short-term trend, and a rush to unwind positions that had been treated as safe until they weren't. The long-term debate continued, but the short-term unwind was merciless. Now, in early 2026, the setup had all the familiar ingredients: a crowded narrative, an explosive move, and a trigger that changed the dollar and rates regime perception fast enough that the positioning could not adjust smoothly. So who was actually moving, and how? Start with the exchanges and clearinghouses. CME didn't cause the crash, but its margin decisions shaped the second act. Once margins rose, anyone holding futures needed more collateral. That meant treasury bills, cash, or liquid assets. If a trader didn't have extra cash ready, they had to raise it. In the real world, raising it often means selling whatever is easiest to sell. That can mean selling more futures, selling correlated assets, or selling equities. That's how a metals problem becomes a broader risk problem. Then there are the dealers and bullion banks that make markets in these contracts. They hedge, they run risk books. When volatility explodes, their models demand less exposure. Spreads widen, liquidity thins. And when liquidity thins, price gaps become more likely. That's the third shove. Volatility itself. Next, consider the funds. Trend followers, commodity index strategies, leveraged ETFs, and short-dated option strategies all behave differently, but they share one fatal trait in a turn. They can all become price insensitive at the same time. When stop levels are hit, or when volatility triggers position reductions, they sell because the model says sell. In those moments, price is not the input. Price is the output. Options add fuel in a way that is easy to ignore until it's too late. When a market races higher, dealers who sell calls can end up long gamma and providing liquidity. But when the market breaks, the hedging flow flips, put buying rises, dealers hedge by selling futures. That is mechanical selling, not a judgment about silver's future. It is why declines can accelerate right after key level breaks, because hedging flows are concentrated around strikes and expiration dates. Even the most conservative institutions can be pulled into the gravity well. If a pension fund or an asset manager holds metals exposure through futures for capital efficiency, a margin hike changes the economics overnight. The exposure becomes more expensive to hold. The trade must be rebalanced. That does not mean they changed their long-term view. It means the plumbing changed. Now layer in the policy actors. A change in expected Fed leadership changes the expected reaction function. If traders believe the new chair is more committed to shrinking the balance sheet, they will price less tolerance for a weak dollar and less willingness to let inflation run. That belief strengthens the dollar, which tightens financial conditions globally, which pressures commodity prices, which forces more liquidation. One narrative can do that because markets are anticipatory machines. So, when people say the dollar crushed metals, that's true, but it's incomplete. The dollar is the first domino. The second domino is collateral. The third is volatility. The fourth is liquidity. The fifth is psychology. By the time the headline reaches the public, the chain reaction has already done its work. Here's where it gets interesting. The same week paper silver was falling, the story on the ground was that physical demand had not evaporated. China's role in silver demand is not theoretical. It runs through solar, electronics, and industrial supply chains. When prices explode, manufacturers can't instantly swap out silver for something else. They can try, they can hedge, they can redesign over time, but in the short run, they must buy silver or reduce production. That creates a floor of real demand that doesn't care about Friday's candle. And gold has its own form of sticky demand. Central banks have been persistent buyers in recent years, and the motivation is not trading profit. It's reserve strategy and diversification. That kind of demand doesn't chase intraday candles. It buys when the window opens. So how do you reconcile this violent sell-off with steady long-term demand? You separate timeframes. The sell-off was about the short term. The dollar snapped back, rates expectations shifted, and leverage positioning had to be cut. The long-term demand drivers did not disappear in 48 hours. They simply got overwhelmed by the mechanics of the unwind. That distinction matters for what comes next, because the market's next move is usually about what remains after the unwind. When a market falls on forced selling, it often reaches a point where sellers are exhausted, not because everyone is happy, but because the vulnerable positions are gone. That's when you start seeing strange behavior. Bad news stops pushing the price lower, or prices bounce violently on ordinary headlines because the marginal seller is no longer stressed. But the data shows something else entirely in this episode. The dislocation between different definitions of price became more visible. There's the futures price in New York, dominated by leveraged trading and hedging flows. There's the physical price in different hubs, influenced by logistics, taxes, fabrication capacity, and local demand. There's the price implicit in ETF flows, where metal is supposed to be held against shares. And there is the price paid by industrial users who must secure supply. These are related, but they are not identical. When markets are calm, they track each other. When markets are stressed, they diverge, and divergences are signals. If New York paper silver can fall 31% in a day, while parts of Asia are still paying elevated prices and scrambling for shipments, that tells you the market is not simply reevaluating silver's usefulness. It is reevaluating leverage. And leverage is always a temporary visitor. It comes when volatility is low, financing is easy, and the trend is clean. It leaves when volatility spikes, financing becomes punitive, and the trend becomes chaotic. The dollar snapback was the moment leverage realized it had overstayed. So how was the move executed mechanically? Imagine a crowded theater with a narrow exit. The crowd is the positioning. Long silver, long gold, short dollar. Long the idea that central banks will always lean dovish. The alarm is the policy surprise, a new perceived trajectory for the Fed. People rush to the door. That first rush is the initial price drop. Then the building manager suddenly narrows the exit. That's the margin increase. Now the same crowd is trying to leave through an even smaller opening. The pressure builds, people fall, and the panic becomes self-reinforcing. At the same time, risk managers start shutting down lines of credit, raising haircuts, reducing limits. Dealers widen spreads. Algorithms that provide liquidity pull back. That makes the exit narrower again, and the panic becomes self-reinforcing. This is why the why is rarely enough. You can have a valid fundamental story and still get crushed in the short run if the position is funded with fragile leverage. Again, that's not advice, it's structure. Now, what does this suggest going forward? Historically, when the dollar rebounds sharply after a prolonged decline, commodities that are priced in dollars tend to struggle in the immediate aftermath. If the dollar strength persists and real yields stay elevated, gold can remain under pressure and silver can remain volatile, because both must compete with the appeal of cash and yield. But if the dollar snapback is only a short squeeze, a temporary rebound and a longer weakening trend, then the next phase often looks like stabilization followed by renewed strength in hard assets, especially if fiscal stress, geopolitical risk, and central bank diversification remain in place. There are a few scenarios the data tends to allow. In a conservative scenario, metals consolidate. Volatility bleeds out. Futures open interest normalizes. The market rebuilds a base as it digests the new policy expectations. In a moderate scenario, the forced selling ends and prices rebound sharply, not because the world changes overnight, but because the mechanics reverse. Short covering replaces long liquidation, and the market discovers that physical demand is still present. In a more aggressive scenario, the dislocation between paper and physical becomes so visible that it forces structural changes. Tighter collateral rules, higher carrying costs, more cautious leverage, and a higher volatility regime where prices swing farther than fundamentals alone would justify. What's worth watching is not a single headline. It's the indicators that reveal the plumbing. Watch the dollar index for whether it holds its rebound or fades back. Watch treasury yields for whether the market is pricing tighter conditions or growth risks. Watch exchange margin notices and volatility metrics, because they tell you how expensive leverage has become, and watch signs of physical tightness, shipping stress, refinery premiums, industrial substitution, because those tell you whether real demand is cooling or simply waiting. This is the part no one is discussing enough, the gap between information and timing. Institutions moved first because they could. They had the models, the collateral, and the mandates to adjust in minutes. Retail moved last because retail always moves last, not because of intelligence, but because of access and incentives. Information becomes price before it becomes narrative. And narrative becomes action only after price has already punished the late response. That's the divide. Not smart versus dumb, not rich versus poor. It is the difference between those who follow the chain reaction and those who only see the headline at the end of it. A dollar snapback is not just a currency story, it is a collateral story. It is a leverage story. It is a liquidity story. And precious metals, especially silver, are where that story becomes visible because they sit at the intersection of money and industry. If this connected dots you hadn't lined up before, you know what to do. This is Macro Signal, where we decode what matters before its headlines. The question isn't whether markets will keep producing these chain reactions. The question is whether you'll recognize the mechanics while they're still unfolding in real time, not hindsight.